Sam&Cents. Money that finally makes sense. There is a number on your pay stub you have never chosen. If you have a workplace retirement plan, find the line that says retirement or deferral. There is a percentage next to it, and there is a good chance you did not pick it. Somebody else picked it, and you agreed by doing nothing at all. Vanguard's How America Saves, published this June with data to the end of last year, reports that 61% of the plans it keeps the records for now enroll people automatically. 20 years ago it was 10%, and since the start of last year a section of the tax code numbered 414A requires many newly created plans to work that way. A default contribution for anybody who does not choose one inside a band the law fixes. The employer still picks the number inside that band, and every plan that existed in 2022 sits outside the rule entirely. The Investment Company Institute's June release counts $9.9 trillion in these accounts as of the 31st of March. None of that existed before 1978. So who chose it? Not you, and not really your employer either. That percentage is the last link in a chain that starts with one paragraph of tax law written in 1978 by people settling an argument that had nothing to do with you. Here is why that paragraph is worth the next few minutes. Almost every default that governs your money grew up gradually. This one you can watch being made. There is a date, a paragraph, a man who read it as permitting a design the statute never spelled out, a client who told him no, and a first installation you can point at. And when we come back, you will be able to look at your own plan and separate three things that feel identical and are not. What is federal law, what is your employer's choice, and what is nobody's decision at all? Every time 1978 reaches something the present is doing again, I will stop and show you the modern version, not at the end. As we go. Three things first. 1. Nothing here is advice. I am not going to tell you what to do with your money, or what any number ought to be. This is a story about where a default came from. 2. I am going to correct a sentence you have heard, which is that the 401k killed the traditional pension. The evidence does not establish that, and we will go through what else was happening at the time. 3. This episode assigns no heroes and no villains in 1978 or now. If you want the short version of what it argues, a default is a decision somebody else already made, and the interesting question is never whether that is good or bad. It is who made it, when, and whether they knew what they were doing. 1978. Buried in that year's Revenue Act is Section 135, which writes a new subsection into the tax code, 401(k), and it was not written to invent a retirement system. It was written to end a fight. Some companies had long-run profit-sharing plans where an employee could take a share in cash now, or leave it and be taxed later. In 1972, the tax authorities proposed rules that called that treatment into question. Congress froze the position for arrangements that already existed, then kept extending the freeze. Section 135 is the permanent answer. It settles the treatment of the old arrangements, and it lets employers set up new ones which the freeze had effectively barred. At its heart is one idea. The mere fact that you could have taken the cash does not by itself make it taxable. What that created was an option, a lever somebody has to reach out and pull. It did not create a rate, it did not create a default. 2 years later, a benefits consultant in Pennsylvania named Ted Benner is reading that subsection, and he sees a use for it the people who wrote it were not aiming at. His reading is that the rules would permit a plan where an employee agrees to reduce their salary, money not yet received rather than a bonus already declared, and where the employer puts in money of its own alongside it, conditioned on the employee putting in first. Employers had matched employee saving before in the older thrift plans. What is distinctive here is the pairing, the match laid on top of the salary reduction under the new subsection. And be careful with the word that usually turns up at this point. This was not a loophole and not an accident. It was an unanticipated use of a permission, and unanticipated is not the same word as accidental. Nothing was hidden. The plan was filed and run in the open. Hold that word option against what your plan does today. The statute created a lever. What a great many people have is a switch that is already flipped. In 1998, and again in 2000, the tax authorities confirmed that a plan could enroll people unless they said no, rather than only when they said yes. The best-known study of what that does is Brigitte Madrian and Dennis Shay's, published in 2001 using data from one large American company in the late 1990s. Comparing employees matched on how long they had been there, participation was about 37% under the old opt-in arrangement and about 86% after the switch. One company, the change also let people in sooner, which the authors account for, but the thing doing most of the work is which way the door had been left. And that is a finding about participation, not about what anybody ends up with. Different questions, and the second is disputed. Back to 1980. Benner designs this structure for a client, and by his own later account, the client turns him down. Accounts differ on exactly why, and I am not going to invent a reason. So he does the thing that makes this story worth telling rather than merely worth knowing. He installs it at his own firm, on his own colleagues, at the start of 1981. One of the first plans of this shape in America runs on the people who designed it. That is an experiment in the old sense of the word. The person proposing the change is inside the sample, and it is worth sitting with how quiet this is. Not a public movement, a handful of firms, separately, filing documents and waiting. And then nothing happens for about a year, and the nothing is the interesting part. Nobody had ruled on a design like this one. You write it, you file it, you run it, and you wait to find out whether the regulator reads the sentence the way you did. If it does not, the tax treatment you promise people may not hold, and the plan has to be corrected or unwound. That is what he sits with through 1981, a position he cannot resolve and cannot retreat from. On the 10th of November 1981, the Treasury publishes proposed regulations on cash or deferred arrangements, and they recognize salary reduction as a permissible source of the money. Now, this is the sentence everybody gets wrong. That was not an approval of his plan. Nobody ruled on his plan, and it is not named anywhere in the document. It was general guidance in proposed form that happened to describe the thing he had already built. Which brings us to the half of his design that was not in the statute at all, the match. Today it is the ordinary shape of an American plan. The employer puts in money of its own, but only up to a threshold written in the plan document, and only where the employee has put in first. This is the easiest place in the whole subject to slip into telling you what to do, so I am going to be flat about it. A conditional match is a term of a contract. The employer's contribution is calculated under a formula, and one of the inputs to that formula is the employee's own deferral rate. That is not a forecast, it is not an opinion, and it is not a claim about what any number should be. It is a clause a great many people have never read, and the reason is the same reason the default works at all. The system was built so you would not have to. 3 corrections, and then we go back. 1. He did not invent the 401k. Congress wrote the provision, other people were working on the same designs at the same time, and at least one large manufacturer was advised to add such a feature before Benner's existed. 2. The evidence does not establish that the 401k killed the traditional pension. Those plans were under pressure from several things at once. Which industries were growing and which were shrinking, funding and accounting rules that made the promises more expensive to carry, insurance premiums, and the decline of the bargaining that won many of them. Nobody has established the weights. 3. Madrian and Shay established a participation effect. Whether automatic enrollment raises what people end up with is a different, unsettled question. James Choi, David Laibson, John Beshears and colleagues estimated in 2024 that once you account for job tenure, vesting and withdrawals, the lasting gain is far smaller than the first-year numbers suggest. Taha Chukmain finds the early gains shrink by roughly 3 years in, while persisting at the bottom of the lifetime earnings distribution. And in Denmark, Chetty Friedman and colleagues found that automatic employer contributions did raise total saving, where tax breaks that required people to act mostly did not. That is a different mechanism from American opt-out enrollment. They are not answering the same question, and I will not pretend they settle each other. A default has a second half. If a plan is going to put money in for you without asking, it has to put it somewhere, and that is also a decision somebody made, and you did not. In 2006, Congress built the machinery, and the Labor Department finished it in a regulation published in October 2007, the Qualified Default Investment Alternative. If the plan picks a permitted kind, keeps it under review, and tells you, and you never make a choice, the plan's fiduciaries get a limited protection from being blamed for the investment result, limited and conditional on having done the choosing and the monitoring properly. In Vanguard's report published this June with data to the end of last year, 98% of the plans that designate one of these defaults designate a fund that adjusts its mix as people get older. You did not choose the percentage. You did not choose where it goes. Neither of those was a decision you made. Back to the design, because there is one more piece, and people usually meet it when a job ends. The employer's money can arrive in your account and still not be yours. That is vesting, and it long predates any of this. The money you put in is yours immediately. The money your employer puts in can be made to belong to you over time, on a schedule, and that schedule is your employer's choice, within limits that federal law sets, which means a balance can be a number on a statement and a smaller number in fact, and the difference is not a market movement and not a fee. It is a calendar. Watch the shape of it. A permission in 1978, one plan at one firm in 1981, and a proposed regulation that recognized salary reduction in general. Then, through the 80s and the 90s, adoption spreads. For reasons employers stated at the time, the cost was more predictable year to year, and a vested balance could move with the worker between jobs. And after that, 3 further changes in law. One permitting automatic enrollment, one giving the default somewhere to go, and one making it compulsory for many new plans. What changes across those steps is not the right to choose. That stays all the way through. What changes is what happens when nobody chooses. And several of those steps clearly raise the number of people taking part. Both of those sentences are true, and if you only ever hear one of them, you have been handed an argument rather than a history. This is where it stops being a story about one man and starts being a pattern. 1978. The option exists. 1981. The option becomes usable. 2000. Enrolling people unless they object is clearly permitted. 2006, the default gets a destination. 2025, the default becomes compulsory for many new plans. At every one of those steps, the right to make your own election survives untouched. What moves is the consequence of not making one, and the number of people for whom that consequence is now decided in advance. Once you have seen that mechanism, you will find it everywhere. The strongest force in a system is rarely the choice on offer. It is the position the switch is in when nobody touches it. Now the boundaries, 4 places this stops. 1. 1981's plan is not your plan. Automatic enrollment, automatic increases, the default destination, the cost disclosure, all later law, none of it in the design we have been following. 2. And this is the one that gets forgotten. None of these rules creates a plan where there is not one. Automatic enrollment only governs what happens inside a plan you are already in. If your employer does not offer one, or you are not eligible, none of this reaches you. 3. The word default sounds neutral and is not. It is an active choice, made by somebody, for reasons of their own. And 4. The one I want to be most careful about. None of this tells you what to do. It is not a case for saving more or less or differently. What you do inside this machinery is yours, and it depends on things about your life that I do not know. So what does that paragraph tell you about the number on your pay stub? It tells you the number is not a fact about you, it is a setting, and settings have authors. The people who wrote the paragraph were closing an old argument. The man who read it was solving a client's problem, then his own. None of them was thinking about you, and that chain set the percentage you are living with. So, the last 2 minutes. I am not telling you to change anything. There are 4 settings in an American workplace plan that somebody other than the participant normally chooses, and all 4 are written in one place: the summary plan description, the deferral rate, the match formula, and the threshold it is calculated to, the vesting schedule and how much of the employer's money is vested, and whether automatic escalation is switched on, and what it escalates to. 4 settings, 1 document. Whether anybody leaves all 4 exactly as they are is entirely their own business. The only thing this episode argues is that there is a difference between a default nobody has read and a default somebody has. Next time, the difference between a promise that is written down and a promise that is actually guaranteed, and how you tell which one you are holding. Same channel. So there it is, small boring moves that quietly win. If your money makes a little more sense now, hit subscribe to Sam&Cents. And the next one's right here. It picks up right where this leaves off. See you there.